I don't see valuations that are unreasonable today. In order for these valuations to be justified for all the contractors, all of the infrastructure companies, all of the computing companies that are selling into data centers, we need continued growth in that capex, that data center capex going forward. We are in an all-time momentum market. Momentum stocks that have been going up, keep going up. We've been in that dynamic really since April 2025.
Q2 earnings season is upon us, and Jed, I just have to ask you, because the key question is, how do we continue to make money? Because people have been making a lot of money. And there's the comments from, I always get his name wrong, but Jeremy Grantham, who was on CNBC, warning everybody about a potential for he said 70% correction, because AI stocks have caused this market to become very incredibly overvalued. What would you say to the people who still want to make money?
Yeah. Well, first of all, I respect Jeremy Grantham. I think he's such an experienced, wise investor, and he's called so many significant turns in markets in the past. I think he's also been too pessimistic, not maybe open-minded enough to the changes in technology and changes in business and capitalism really over the last 15 years. And so hasn't been bullish enough over the last 5 or 10 years. And all that fully disclosed. I don't see valuations that are unreasonable today. I see valuations that are probably more high than they are low, but I think that that's justified based on just the exceptionally rapid rollout and use of these new AI tools. AI is an incredibly expensive technology to serve, and so we're seeing just this massive boom in investment in AI accelerated computing data centers, and that is generating dramatic, business changes and profit improvement for companies that serve the construction of those data centers, whether it's the equipment inside, the semiconductors and networking gear that goes inside the data center, or the contractors that are installing HVAC equipment, or
let me interrupt you on that. It's a perfect time for me to plug something, because we are content partners with Yada 2026. This is the big conference in Las Vegas where all of the contractors, where the people who build data centers gather every year, along with private equity. And there are some VC who attend this as well, looking for opportunities to spend money. But back to your point, Grantham is saying a potential 70% correction, which you think is overly aggressive. What are we possibly missing that he is seeing about the potential for the data center build out? Because the estimate is 2027, $1 trillion just on data center build out in the United States. Total, I think, spending for AI in 2027 is estimated at over $3.5 trillion. What is he seeing that we're missing? That
this build out of accelerated computing data centers is going to enable a re-architecting of the way business gets done, and the tools that consumers use to live their lives, entertain themselves, get things done, etc. And this new way of computing, accelerated computing, is going to replace virtually all of the CPU-based computing infrastructure that we have in the world. And that build out, that replacement, is going to happen over a decade plus, not just a couple of years. It's not just a couple year boom in spending that's going to be followed by a bust.
So that's what he's missing.
I think so.
Okay. So let me ask you this. As we head into Q2 earnings season, what should investors look for to signal that the market, while expensive, is not overvalued?
Yeah. A couple things. Number one, continued acceleration in the revenue growth for the cloud computing giants. So that means Amazon, whose AWS business is the largest cloud computing provider in the country, And then number 2 and number 3 are Google's GCP and Microsoft's Azure. Those 3 have been showing accelerating revenue growth. So measured year over year compared to the prior quarter. Amazon has accelerated up to 28%, I believe, from 23% the quarter before. We should see a number in the 30s, probably the mid 30s. And I think that's headed into the 40s by year end 2026. That acceleration represents growing demand for these tools from both businesses and consumers, and makes Amazon and GCP and Azure more excited about investing in more data centers going forward. That's why their annual capex spending is going up year after year by really significant amounts. And in order for these valuations to be justified for all of the contractors, all of the infrastructure companies, all of the computing companies that are selling into data centers, we need continued growth in that capex, that data center capex going forward. And 70% of that comes from those big 4 cloud giants, the 3 I mentioned plus Meta.
So as we talk about CapEx, they're generating the revenue to sustain this. But one way they're doing that is they're issuing new stock, new shares. They're not buying back. It's the opposite, which wouldn't that dilute my holdings if I'm an investor, thus creating a problem going forward?
Minimally. Yeah, so Google issued, if I remember, $80 billion of equity. It's the first equity issuance they've done since coming public, the first material one. So that's a change. Why are they behaving differently? Why'd they do that? Because they are so optimistic that their company investing in new accelerated computing data centers, they're so confident they're going to earn a good return on that investment that they're willing to issue equity, dilute their existing shareholders by just 1 or 2%, but still more than they have in the past, like you mentioned, in order to do so. The ROI is that compelling for Google.
As we look at Q2, let's turn our attention away from the big mega tech companies. And we've published articles, we have contributors from other investment firms who've written about the fact that small cap, mid cap have really outperformed for the last year and a half, beating the mega cap stocks. And are your clients missing this, or are they capitalizing on this? And what are you looking for as those less attractive names, simply because of their size, will also be reporting their earnings?
Yeah, you really set that up well. Large cap has been outperforming small caps and mid caps for a really long time, a decade plus. Market trends don't go on forever. Trees don't grow to the sky. There is a cyclicality and a rotation aspect to markets, and small caps and mid caps are outperforming large caps this year for the first time materially in quite some time. It's been good to see, I think, for the markets as a whole, as equity markets have just gotten more and more concentrated into fewer and fewer large cap companies. So good to see that small cap outperformance this year. Separate note, we are in an all-time momentum market. Momentum stocks that have been going up, keep going up. We've been in that dynamic really since April 2025. And what differentiates this momentum market from the last great momentum market, which was in 1999 and 2000, is the momentum stocks this time around have earnings support, largely from that AI data center build out. And we are seeing more and more small and mid-sized companies benefit from various shortages in that technology supply chain. That's I think, a good chunk of that small cap outperformance. And then we've also seen a huge rebound in biotech, whereas small caps are, which are heavily represented in small caps, and then also the banking industry, which has had a really nice year.
So before we wrap up on all of this, are there any names, whether they be large cap, I think we know the large caps, but mid cap or small cap stocks that you'd want people to pay attention to?
Yeah, MedPace is one that I would call out, the first stock that comes to mind. So MedPace is an outstanding company. It's a long-term outperformer. MedPace is a clinical research organization. What that means is they're an independent company that drug companies hire, smaller drug companies. They hire MedPace to kind of shepherd their drug through level 1 or phase 1, 2, and 3 trials. and get the drug approved and on the market. MedPace has a lot of expertise and facilities useful in this process. And so, AI is resulting in more drugs, more drug ideas, and screening and things like that. So I think that, MedPace, there's good industry tailwinds benefiting that company. And also it's really a high performer in their industry. They've been gaining market share for decades at this point. It's a well-managed company. Stock did not have a great year in 2025, but has been rebounding nicely in 2026. I think that's a good mid-cap idea today.
Is there any other stock that you could share with us that you would want people to pay attention to?
Yeah, sure. Another one is Cintas, which is the uniform cleaning company. Sounds like a boring, basic business. This is kind of a non-AI idea. What's neat about Cintas, I think, today is they are trying to buy one of their biggest competitors. They have an agreement to buy UniFirst. It's in regulatory review right now. We think the deal will close sometime in the next year, and that is a really good opportunity for them to consolidate their industry. And then on top of that, they're having decent organic growth. There's been obviously a revival in industrial activity that I think will benefit Cintas, and it's also just a very well-managed, kind of dominant company in their industry.
All right. So now I'm going to wrap it up. I'm going to give you the last word, which my friends and family would be shocked because I like to argue. But I will give you the last word. Again, the focus Q2 and how do we as individual investors proceed to make money with all of the doom and gloomers saying, get ready, red flag, correction coming.
There's a lot of volatility in markets. Feels like volatility has been picking up here in recent weeks. And we've seen some of the semiconductor stocks pull back after just a monstrous doubling in the second quarter. Don't let that volatility chase you out of great companies. I think what we're going to see in the second quarter is exceptionally strong results from the big capex spenders. We're going to see exceptionally strong results from the companies that are helping get these data centers erected and opened. And the AI trade remains intact. All investors should be diversified. They should own a bunch of AI stocks. They should also own non-AI exposure. But don't get scared out of the AI stocks by this volatility. I don't think there's any real fundamental change in the demand exceeding supply story that we have today with tokens and data centers.